is run by a bunch of investment bankers, and Morningstar's tools can help make
For Morningstar, I'm Jeremy Glazer. Earlier this month, President Obama signed into law the Jobs Act, which among other things tried to make it easier for companies to raise capital, but will it have unintended consequences for investors? I'm here today with Vice President of Global Credit and Equity Research, Heather Brilliant, to take a closer look. Heather, thanks for joining me.
Thanks for having me, Jeremy.
So let's start by taking a closer look at this act. Obviously it covers a lot of different areas, a bit of an omnibus, just kind of threw everything but the kitchen sink in there. But particularly to IPOs, what are some of the different parts of the bill that you think are going to have an impact, to average investors?
Well, I think there's a couple of unintended consequences, provisions that are in the bill that we think actually reduces the disclosure that these companies will have to provide around a possible IPO, and also possibly even makes the research available of less quality than it was before, if that's possible.
So let's take a look at some of the specific provisions. A lot of them have to do with filing your S-1 before you go public. What are some of the changes that we're going to see there?
So a company right now has to file an S-1 a good 3 to 4 months before they'd like to go public. And they have to make that available to the public so that other independent research firms or outside participants can evaluate the company as well, and outside investors can do their own analysis. Well, under this new provision, companies with $1 billion in revenue or less with less than $1 billion in revenue will be able to file the S-1 a mere 21 days before their roadshow starts. So you'd literally have less than a month before the IPO to evaluate the company. On top of that, they are actually going to require fewer years of disclosure around how the company's been doing, so it'll be a lot harder for analysts and for investors to get a sense of what does this company look like.
Now, what about financial controls? Are they going to make it easier for companies to go public, not having to get your auditors to sign off on the entire system? Any changes there?
They're no longer requiring a formal auditor sign-off in terms of internal controls. So what that means is that a situation like Groupon, where you saw a mere 1 quarter after going public that they had some internal controls even after having been formally reviewed that were not all squeaky clean, those kind of things are likely to happen a lot more frequently under this new Jobs Act.
So you mentioned that investors are only going to have about 21 days from the S-1 until a potential IPO. What are the implications, for the research then? How is that going to work out in real life, you think?
So the only people who will have more than 21 days of disclosure will be the investment banks doing the IPO. And in the past, those investment banks have been prohibited from writing research. Well, under the Jobs Act, those investment banks will be able to publish research around these smaller companies going public. And so what that means is that you will have the banks who are doing the deal, who have an incentive to make the deal look particularly good, being the primary conduits for research around these companies. The goal is that would increase transparency because there will be more research around some IPOs. There may be more research, but we think the quality will be low enough and the incentives will be great enough to inflate the IPO that we would expect to see even more IPOs fizzle than we've seen already.
So given some of these changes, does that impact the way that Morningstar thinks about IPO investing and thinks about if it's advisable to get into a company when it first comes public?
Well, as a non-bank, we will not have any information until 21 days before. So we'll have less time to evaluate the IPOs we look at. And on top of that, we expect to like them less because it's the reason why this act could be good for companies is that the investment banks might be able to get a more full price for the company, but that means less return potential for investors. So already you see many, many companies pop on the day of the IPO only to fizzle thereafter. We would expect that to be an even more common occurrence.
So it sounds like this act may achieve its goal of making it easier for companies to go public, but it might make it a little bit less attractive for those who are actually investing in those IPOs.
Yep, that's right.
Well, Heather, thanks so much for joining me today.
Thanks for having me, Jeremy.
For Morningstar, I'm Jeremy Glazer.